Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Urs Ramseier, who's the Chief Executive and Chief Investment Officer at 12 Capital. Urs, welcome.
Yeah, thank you.
We've looked at this series over the last couple of podcasts about sort of the impacts and effects of COVID-19 more broadly on financial assets and how it's changing the economy. But today I thought, given your background as an investor in insurance and reinsurance, what impact you've been seeing on those particular areas?
Yes, sure. So if we look at the impact on the insurance sector, we have to make a differentiate between what we call the asset side of an insurance balance sheet, so the insurance companies as investors in the financial markets, and then the liability side, the right side of the balance sheet. So what type of claims could come up based or due to the COVID-19 crisis. Let me start with the underlying insurance business, so with potential claims. And here, again, we have to differentiate between life insurance and non-life insurance. On the life insurance, obviously, it's about mortality. So will there be any big claims for people basically dying due to the COVID-19? With this regards, from investor point of view, we're quite relaxed because typically the people insured for mortality are in the age between 40 and 60 years old. And this is not the population most affected by COVID-19. The population affected is above 65, and that part of the population is typically not insured for mortality. So here we do not expect big claims for the insurance industry on the life side. On the non-life side, it looks slightly different, and the most exposed business lines here are commercial insurance, and within that it's what we call business interruption. So basically, insurance companies are buying if they have to close down the business for various reasons, but typically this is property insurance, so property damage. Now, what is the base assumption of the insurance industry is that pandemic is not included in business interruption. In many policies, it's excluded. So then I think there are no claims coming to the industry. But there is a whole category of policies out there which do not really include or exclude specifically this pandemic in the business interruption contracts. And this opens doors for potential claims to the industry. And here we have to assume that there will be, I would say, significant payouts from the insurance industry for these business interruption claims. So our estimate is something between 20 and 40 billion US dollar globally, primary insurance and reinsurance for business interruption due to pandemic, due to COVID-19 pandemic event. And then lastly, there is also in commercial insurances is event cancellations, Olympic Games and others. This is a category of contract where the client explicitly bought pandemic coverage and is now compensated for it if the event is cancelled. So the Olympic Games in Tokyo is a good example of that, which is known to have bought such coverage. So that's the non-life, that's the liability side of the balance sheet. On the asset side of the balance sheet, obviously insurance companies are large investors in financial markets. It will depend where equity prices and bond prices will end up or will develop over the next few months. But what we can say is typically insurance companies are invested in investment grade or treasury bonds, real estate, to a lesser degree high yield and equity, simply because high yield and equity has much higher capital requirements, especially in Europe after the introduction of the regulatory framework called Solvency II. So they're less exposed to those asset classes. So we would assume that the investment portfolios of insurance companies are more on the higher quality end of the spectrum, and losses are not as significant as it might be for other investors. Having said that, obviously there will be a significant impact in total to the industry on the investment portfolios. So all in all, it's a big event for the insurance industry on both sides, on the investment side and the liability side, but it's digestible. If we put the business interruption now only 20 to 40 billion into context of natural catastrophes, that's a mid-sized hurricane. On top of that, we have then the event cancellation and some smaller businesses. And then obviously the asset side, but it's digestible. It will be a large degree an earning event, not a capital event, and from that point of view, it's not fundamentally something where the industry should be worried. There are also business lines which profit from the situation, from the lockdown. Mostly motor insurance, because people drive less, there are less accidents, the premiums are paid. So certainly motor insurance will have very good profits this year in countries where there is a lockdown, which compensates to a certain degree for losses on the commercial business the commercial business lines. Mm-hmm. So it's still too early to come up with a final number, but where we have some confidence is it's not a life-threatening event for the industry as a whole. What is also unclear is how much of the losses will be with primary insurance and how much is reinsured. So here is quite a big uncertainty. We would assume that it's more in the primary insurance compared to a large natural catastrophe rather than in the reinsurance segment, but that is highly uncertain also for the companies themselves.
So you've given a really big, broad background of areas that we can dig into here. Let's maybe start off with some of the policies to kick off. You know, historically, pandemic wasn't very common in human health insurance. You mentioned, yeah. but in terms of commercial, it was included as part of business interruption. So that's what's happened. Is it still too early to tell in terms of the impact that has come from COVID-19 and its impact to business?
Yes, it's by far too early because, the big uncertainty is around policies which we call so-called silent, so which do not include or exclude pandemic in the business interruption contract, and there is some legal uncertainty around that. And there is a big range of policies out there in different countries, even generation of policies. I even think that insurance companies themselves do not know what exactly the exposure is. What we also see in some countries now is that insurance companies start to settle themselves these claims. So they say, look, regardless of the language in the policy, we offer you, 50 or 60 or 70% of the insured sum. And then the whole claim is settled. So we see this increasingly happening in certain jurisdictions. Whether this is then also covered by reinsurance, that's uncertain again, or whether this is something that the primary insurance companies will pay. So it's really uncertain. As I said, the consensus estimate for business interruption is 20 to 40 billion industry loss. I think in that range we're comfortable.
Let's then take it to balance sheets and how they're affected. You know, you said that at the moment the primary and reinsurers can handle that sort of piece, but then if you look at their asset side and what they've got to invest in from the investment grade, treasury, corporate bonds, high yield, and equity, you know, these seem to be all very challenged areas to find returns. You know, is the business of insurance really getting a lot harder for them in terms of trying to manage the asset and liability mix?
I mean, first of all, it's about assessing the impact of the last 6 to 8 weeks on their investment portfolios, as any investor does, right? Also the larger pension funds. So, and then going forward, yes, where do they invest? And they will stay within the asset classes that they have done in the past, just simply because of capital requirement for these different asset classes. So it will be investment grade, it's treasury, it's to a certain degree real estate. They will not go into high yield or not increase significantly their equity allocation because the capital requirement is simply too high. But given that it's challenging, I fully agree, and that means that the insurance companies will focus even more going forward on underwriting profits, so operational profit on their core insurance business. So that's clearly the focus. They have to make the money from the insurance business and not from the investment portfolios.
So it's about increasing premiums ultimately.
Yes. So premiums will that's for sure. Premiums will go up across the board in primary and reinsurance. It starts already in reinsurance, significant premium increases. So that's something which is already happening as we speak. Premiums are pushed up by significant amounts.
Mm-hmm. Are you expecting any changes from a regulatory standpoint as the regulators around the world start to think about the need for capital for insurance companies? Is that likely to change?
Yes, certainly for pandemic. But however, pandemic has always been looked very closely by regulator, and typically pandemic is reinsured, right? Mm-hmm. So primary insurance companies buy pandemic cover from the large reinsurance companies for the really big mortality events typically. So they will look much closer into pandemic risks and ask the insurance industry and companies to do scenario testing, even for a second wave of COVID-19, for other viruses further down the road, the impact on the different business lines. So that's something which will be obviously on top of the agenda by regulators.
Mm-hmm. Let's think more specifically to sort of cat bonds, and they've been obviously. They've been in the interests of pension funds locally in Australia, but they seem to sort of wane with interest. They sort of go with cycles. When these sorts of events happen, there's a lot of interest and people get excited and think about an opportunity. Then it seems to sort of dreary out a little bit, and then it comes back. Why do you feel that that's the case? Is it a matter of pricing and returns, and they're sort of coming in and out, and people then look at it after one of these big events?
Yeah, I mean, cat bonds are to a large degree exposed to natural catastrophes, and within that segment, the U.S. hurricanes and California earthquake, and a few others. So that's where cat bonds are exposed, and where people, investors, get a coupon or a premium for it, right? And the big advantage attraction of cat bonds is they're uncorrelated to financial markets. Now, what we can say is that cat bonds are not affected by COVID-19. There is no impact. There was a pandemic bond out there, but it's rather small, and many portfolios did not have that one. Business interruption is not an issue for cat bonds, and spreads and yields have gone up significantly over the last 6-12 months already, and just go further up now in the current situation. Mm-hmm. So what it shows now, the volatility in financial markets basically increased the demand for something which is uncorrelated, which diversifies the portfolio. So we see big interest, increased interest in cat bonds. People believe that volatility will stay there for quite some time, and to have an allocation to an asset class which is not correlated, and the performance of cat bonds portfolios or the index year to date is positive or flat to positive. So that demonstrates that that this asset class is not correlated to other investments. So the demand for cat bonds is going up. Now with the premium increases in the underlying insurance and reinsurance, the cat bond spreads continue to go up as well. So the yields are better than 2 months ago, 3 months ago, 6 months ago for the same risk. And as I said, investors are increasingly looking at this asset class again.
It's interesting you mentioned that, because one of the big issues, particularly in Australia, is around climate risk and the impact of climate risk. And you read the market news, and the narrative that's out there is that climate events are getting more and more frequent, and the impact is getting larger as well. I guess one of the probably common questions you receive is, am I going to be more and more exposed if I go into cat bonds, given what I'm reading about climate risk that's coming? How do you respond to that?
Yeah, I mean the cat bonds are the two main exposures of cat bonds is California earthquake, which obviously is not has no impact from climate change due to the earthquake risks, and then the other one is East Coast hurricanes and typical Atlantic hurricanes, and here obviously there is an impact by climate change. So what we have to expect is more frequent and also more severe hurricanes. Whether there are more landfalls, then, however, is still not clear. What we observe is that the number of hurricanes do not make landfall; they turn on the Atlantic. So there are different scenarios whether this really leads to more insured damage for U.S. hurricanes at the East Coast. Having said that, given that we observed a significant premium increase in the market, so already before COVID-19, roughly 2.5% higher spreads in cat bonds than 12 months ago, and now the next 3 to 4 months it will go up even further for the same risk. I would argue that the premium we get largely takes any uncertainty of the climate change impact on U.S. hurricanes into consideration, into account. I think investors get very well compensated for the risk they take.
Mm-hmm. Is it a pretty broad universe in terms of the bonds that are out there? In particular, like different areas, different geographies. How segmented are they?
Yeah, it's heavily focused to California quake and U.S. hurricanes. That makes about 60 to 70%. Mm-hmm. And then there is Japanese typhoon, Japanese quake, and a few others. But clearly, what we call these peak risks, so that's the highest concentration of insured values in an exposed zone globally, are the best paying perils. So they have much better risk returns than let's say Australian wildfire or Australian risks, because these are diversifying type of risks. It's I would say it's rather concentrated, which has advantages and disadvantages. But within U.S. wind, there is a certain diversification from Gulf of Mexico even up the East Coast to New York, and these are the concentration of the cat bond segment.
Mm-hmm. And you guys look at insurance bonds. What's the underlying assets that are part of that? How are they split?
I mean, insurance bonds are bonds issued for to raise regulatory capital by insurance companies. Mm-hmm. So the QBEs and the Allianz and AXAs and the AIG of this world, they issue these bonds to increase their solvency capital as an alternative to equity, where the regulators encourage them to do so. And there are different levels. There is tier 1, tier 2, tier 3 type of bonds. But clearly, what it's all about, it's about solvency and the risk to lose money in an insurance bonds is only when the solvency ratios fall below a certain level. The solvency ratios of the insurance industry is very solid. Has in Europe, give an indication, fallen from 200% to roughly 190% during the COVID-19 crisis, taking investment losses and insured losses into consideration. So the industry is very well capitalized. So there is no risk, in my view, of default or a coupon deferral in insurance bonds, and the yields in this investment grade and an investment grade strategy are probably the best across all sectors. So very attractive yields, very small coupon deferral or default risk. So we consider insurance bonds in the current environment as very attractive within investment grade.
Mm-hmm. And you look at insurance stocks as well. So I'm curious in terms of the trade-off as you compare those two options in the capital stack. How do you make that comparison, and what are you looking for?
Yeah, in insurance bonds, you have to be more selective than in the bonds. As we said, there are some companies which will be largely affected by the COVID-19, and the others that they're more or less unaffected, depending on the lines of business they're writing. The sell-off in insurance stocks has been more or less the same across the sector. And I think if you choose and select well insurance stocks now, then you can make out a lot of money, because some stocks are trading at less than 50%. That's where they traded mid-February. So there is significant upside in some of these insurance stocks, especially also if you think about the significant premium increases we already see on the businesses. Insurance bonds, it's more a sector call. I mean, I do not see any risk of default of any of these companies out there. So basically, do you think insurance bonds are attractively priced versus the risk or versus other sectors? And then it makes sense to invest into a broadly diversified portfolio of insurance bonds. Typically, what people do is they compare insurance bonds to banking bonds. And we believe that insurance bonds at the moment are more attractive than banking bonds in terms of yield, but also in terms of lower risk.
Mm-hmm. And are there quite distinct differences between the risk, the spreads on these bonds across, around the world?
Now, the spreads are about the same around the world, US, Europe, and even Australia on the same. If on a comparable rating level, it's more than the currencies and what the cost of currency hedge into your home currency. But the spreads are about they're about the same.
Mm-hmm. And in terms of your remit of areas that you look at, is there a portfolio that you create more broadly across these sectors, or is it more looking at each individual sector uniquely?
Now we look at each individual sector, obviously, and manage portfolios for each single strategies. But then we have also portfolios which look at the asset classes across the board. So equity bonds, cat bonds, and so on. Where we pick also the best relatively priced securities. That's something we also do. And as I said, we see this big upside in some of the stocks. Insurance bonds in general, we look at attractive, and cat bonds have just become very attractive now with recent spread widenings.
Mm-hmm. And when you talk to investors from Australia, for example, how do they think about allocating? Because if you think about the Australian market, a lot of the challenge is where the different investments sit. Which bucket do they sit? Do they sit in fixed income and equities? Where do catastrophe bonds, for example, sit? Versus insurance bonds, insurance stocks.
Catastrophe bonds typically are considered as alternatives, right? Mm-hmm. I mean, in the alternative allocation, and one of the main benefits is the uncorrelated nature of cat bonds, truly uncorrelated, and that has proven to be so, and it is obviously a big benefit in times like the last 6 to 8 weeks, something which has positive performance during such a crisis. Then insurance bonds, it's within fixed income. It's an allocation in corporate bonds, investment grade, a sector allocation, but it's fixed income corporate bond. And then equity, obviously, is in equity. The multi-asset class portfolios tend to be also in alternative.
Mm-hmm. One of the things that we didn't touch on in terms of the current economic crisis, in terms of the population being under pressure and potentially not paying insurance, is the industry also going to be at risk because of this current pandemic?
No, I think it's rather an opportunity for the industry. I mean, this industry, that's why the industry is there, right? To cover these kind of risks for the policyholders. But I think it's an opportunity. Very few people, for example, bought pandemic coverage in the past. It was not considered as a major risk by many companies. And now it is. So I think this will be a fast-growing business line. And the insurance companies will make sure that they get the right premium for it and price for it. So that this is certainly an area of growth. Then the other area of growth is, as we already mentioned, is climate change. Climate change will happen, and companies think about how they can mitigate that risk. And here, the insurance industry is there to assess these risks and to price it. So I think these two, what we can call maybe type of mega trends, will lead to a situation that the industry as a whole will grow over the next 5 to 10 years.
Mm-hmm. Is there any other innovation that you're seeing in the insurance industry for sort of dealing with these risks? And you mentioned the new developments in the industry.
Yes, I mean, there is a lot of innovation on the risk assessing, modeling side of things. Typically based on machine learning tools, big data tools in terms of climate change, meteorological impacts, and so on. So the models we use to price natural catastrophe risk are much better developed than 5 or 10 years ago, based on these new technologies and new data which is available. So that's one thing. Then also the role financial investors play in the industry with cat bonds or insurance-linked securities. That segment will also grow. So there will be more and more of these risks basically going directly to financial investors and not remain within the insurance balance sheet. So there will be a much better split. Mm-hmm. and diversification of risks within the owners and ultimate owners of the risk. So there is a lot of innovation going on, and then ultimately there is a large part of the global population which does not have access to insurance coverage simply because they cannot afford it in emerging markets. So there's a lot of innovation going on. Also, how can we give these people protection against climate change, but also now pandemic type of events in terms of resilience and risk mitigation. And here again, the insurance industry, but also financial investors are at the forefront of the development.
One last area that we haven't looked at, which is liquidity and the ability, obviously, to trade some of these bonds. What does that look like?
I mean, in cat bonds have been pretty liquid over the last two months. There was no liquidity crunch in cat bonds. Maybe there is some market-to-market movements, but that's very small. Insurance bonds as well. In mid-March, we saw a bit of selling pressure, but that was just a few days, and then it was basically over. And equity, we did not see any liquidity issues. I think it's also due to the fast and very big reaction by the central banks, especially buying investment grade bonds, corporate bonds, providing sufficient liquidity to the markets. But we did not see any liquidity crunch last 2 months in our segments.
Thank you very much for your time, Urs.
Thank you, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.